SKF India, well, the numbers are pretty much in line, the bearings player that is. We have Mr. Manish Bhatnagar, the MD at SKF India, who joins us on the show. Hi, Mr. Bhatnagar. Good morning. Thanks so much for joining in. Well, what surprised positively was the gross margins. They've come in much higher than the averages that we've seen in the past. I think it was around 41% odd. What caused this? Was it the product mix? Was it the price hikes? Localization? What was it? If you could give us some clarity on that front. And what do you end this year with? At the 9-month mark, you're closer to around 3,200 crores odd. Somewhere in the vicinity of around 4,500 crores?
Yeah, well, the first part of the question, why were the margins so good? A combination of everything you said. A localization, that's been our strategy for a couple of years now. It's playing out rather nicely now. Clearly, the margins on manufactured products locally are better than traded products. So that's helping us. But also, more importantly, price realization of price increases. We've been able to offset a lot of the inflationary pressures by talking to our customers and making sure we get the price realizations we need. And of course, there's always a deep focus on cost controls. Nothing has changed on that over the years. So a combination of many factors getting us there. To the second part of the question, I don't want to give any forward guidance for sure, of course, but I think what you saw in last quarter would be our trajectory going forward.
Okay. So can you tell us a little bit about the auto segment? Because over there you have a large presence, whether it's in auto replacement demand or even in the two-wheeler space, which has seen a slowdown. I mean, we haven't seen any major recovery in the two-wheeler OEMs, especially the ones that have an exposure to the rural markets. Are you facing any challenges there? And what kind of growth do you see for your own business from the auto segment?
Just to clarify, auto is a large part, but it's not more than half our business. So we are half automotive and half industrial. But specifically on automotive, the half of our business, yes, two-wheelers has been a slowdown, not been a great story last 6 odd months, partly because of inflationary pressures. We've seen two-wheeler prices go up 10, 15%. And the two-wheeler buyer, unlike, let's say, a car buyer, is possibly much more impacted by inflation. So they would either delay their purchases or maybe buy a second-hand vehicle, etc. So two-wheelers, we are seeing a slowdown, like with every other OEM in the country. But on the other automotive segments, commercial, passenger, tractors, we are seeing really good growths. And because we are so well diversified, the two-wheeler slowdown in a way is kind of offset by the growth in the other segments.
But don't you think that because of the slowdown that you're seeing in the two-wheeler space, it could restrict the overall growth that you're looking at? I mean, you're still sitting at about just about making it to the double-digit growth mark, especially in the quarter gone by. So do you think that this slowdown that you're seeing in some of the pockets in the auto segment could restrict your overall growth? And if yes, what could it be in FY24?
Yeah, actually, we are over double-digit marks. We were 11% growth over last year. But none of our segments is so huge, frankly, that it will impact our business. So even the largest segments are about 7, 8, 9%. And the whole point of being a very well-diversified company is that if one segment goes down, so yeah, two-wheelers are slowing down, but industrial, which is 50% of our business, is doing extremely well across segments. So yes, there's a concern on two-wheelers for sure, but not something that I would lose sleep over.
Can you talk a bit about exports? Because you've refrained from growing your exports aggressively, unlike what you're doing in the domestic market. Could you talk about the game plan there? What is it that you're seeing in the export market and why this strategy?
We are very clear. We are not an export-driven setup in India. We want to focus on the domestic market, lots of opportunities here, and we've been consistent in saying this. Exports is about 7, 8% of our total business. We use exports sometimes to support other SKF factories around the world when they have production challenges. But we don't really have sales teams out there chasing exports. And the most important reason is that bearings, we believe, is much more a localized play than an exports play. Customers, very often, we gain share by promising customers availability and reliability as close to their factories as possible. I don't think there's a big play for us to make from exporting from here to the US or here to Latin America or here to Europe. Customers there would much rather prefer nearshoring
Yes.
of manufacturing. So that's why we have not focused on exports from India, and domestic is our focus.
Just getting back to the point about margins, this quarter's margins at 17% is lower than Q2 margins of 20%. You said margins will sustain at 17% going ahead in Q4, or can it get back to the 20% mark?
No, maybe a little higher.
Q4 margins better.
Yeah, 17, 18, 19 is where we think we will be. 17 is the lower end, maybe 19, 20 is where we should be.
Okay, all right. So we've got the margin band from you. A quick question. What about market share? I believe the Chinese bearing companies, again, they have started exporting. Any kind of impact to y'all as of now, or you're seeing that as no impact? What about your current market share? If you could tell us, the verticals that you function.
Yeah, so we have our own estimates of market share. Unlike some other industries, we don't really have third-party data on that. We think we're about 20 to 23% market share. But the Chinese impact on bearings, or in general imported bearings into India, is not so much on the OEM space, for the reason I talked of earlier, the export example I gave earlier. So the Chinese or the imported bearings mainly play in the low-end aftermarket.
Okay.
And because the OEMs, frankly, don't want to take a chance because it's a small part of their product, but it's a very important part. Product would fail with a bad bearing. So they don't really want to go in for that cheaper bearing just to save a few pennies here.
So you're not experiencing any kind of impact to the businesses that y'all function in for the reason that you're giving us. That's good news. Very quickly, you said Q4 will be as good as Q3 maybe. On the revenue front, so you're doing around 1,100 crores per quarter. At peak levels, so I'm guessing you end this year closer to around, 4,300 crores at least. At peak levels, you'll have done some capex in the past. What is the revenue potential of the company?
Well, the potential is as large as the market is. We are 22% market share right now. Multiply that by 4.2 times, and you get the total potential of the company. That's what we aim for. Of course, we won't, of course, get there. But I think our capex plans, what you mentioned, is about 200 odd crores every year. And really, that capex is aimed at localization. And with that localization, we hope to gain share. We're right now 22%, maybe 23, 24, 25, but anything in the mid-20s would be a good number to aim for.
Are you seeing any traction from the railway segment? I'm asking because the government is, going big into this segment in terms of investments and potential there. Anything that you gain out of it?
Big gains for us in the railways, mainly on the freight segment. The big investments coming out in freight, not so much passenger or metros. So, and we now have our bearings qualified for local freight wagons. And
Can you quantify it for us, what the amount could be?
For railways, it's about 8% of our total business.
Okay, all right. We leave it at that. Thanks a lot for joining us. Appreciate your thoughts and your business as well. You've done a lot for shareholders in the last many years, so hopefully that could